Hello everyone, so today we are going to start with a new unit, that is retirement of partner. So till now we have seen the treatment of goodwill, the admission, and also the introduction to partnership, which was just the basics, top notch of the of the whole partnership accounts. So the main chapters are your treatment of goodwill and your admission. So after admission there is the next part, it is my retirement of a partner. So what happens? Again, let us take some examples. So there are three people now, right? After admission there were three people. So it was Karthik before, then it was Krishna, and the third person's name was Chinmay. Now what happens is Krishna wants to retire from the firm. Krishna wants to retire. He says, I am too old now to do this work, so I will be taking retirement. So now what to do? So what we will do is, first of all, before going to the what happens part, let us see what happens with the ratios. Okay, let us say we were the partners at the ratio of 1 is to 1 is to 1. Now what happens after retirement of Krishna? After retirement of Krishna, the ratio stands at 3 is to 2. Karthik will be having more of the profits, whereas Krishna will have whereas my Chinmay will have lower level of what profits. Now comes the main part. Now, how do you compute the gain ratio? Now, in this chapter, we call it as gain ratio. See, in the old chapter, it was called as sacrifice ratio. Why? Because there were the existing partners who were sacrificing some portion of their profit sharing to the new partner. But in this case, what happens? Since Krishna is retiring from the firm, what happens? He will give some portions to whom? Some portion to Karthik, some portion to Chinmay. Now, this portion, whatever they stand as a gain, will be called as what? As what? My gain ratio. As my gain ratio. Now, what is the formula for this? Since we know that whatever old ratio they have will be lower than the new ratio. Why? See, because Karthik had 1 by 2, right? And Chinmay also had 1 by 2. After retirement, after the retirement of Krishna, the ratio stands at 3 by 5 and 2 by 5. So that means basically they have gained some portion from whom? From Krishna. Now, how to compute this? See, the formula will be for the gain ratio, new ratio minus old ratio. Since new ratio will be greater than the old ratio, we will be keeping the new ratio on the first, and then we have the old ratio. Simple logic. Clear? Okay. Now let's see how to compute. There are various cases, just like the previous chapter. Here also there are various cases where we will be computing the gain ratio. Let us see one by one. Okay. See, for examination purpose, there might not be too depth questions on gain ratio specifically. Clear? It might be a small part in the whole question of 20 marks maximum. Okay. Let's see. So, case number 1. ABC are partners sharing profits and losses in the ratio of 1 is to 2, 1 by 2, 3 by 10 and 1 by 5 respectively. B retires from the firm and A and C decide to share the profits and losses in the ratio of 3 is to 2. So what is the old ratio? What was the old ratio? Okay, first of all, always remember, make the denominators equal. See, in this case, it is 1 by 2, 3 by 10 and 1 by 5. They are not likely terms, right? So make them equal first. So how to do that? So if I keep 10 as the base, so that would be 5 to the 10. So 5 by 10 is 2. Then 3 by 10 is 2. 2 by 5, right? So the ratio would be 5 is to 3 is to 2. Between whom? Between A, B and C. Between three people. Now sir, how did you do this? In the maths chapter? In the maths ratios and proportions, this is clearly taught to you people. Clear? Okay. Then what is the new ratio? What is the new ratio that we are dealing with over here? The ratio would be 3 is to 2, right? Or 3 by 5, 2 by 5. Now how do you compute the gain ratio? So computation of gain ratio. How do you do this? So for Mr. A, that would be new ratio, that is my 3 by 5 minus old ratio. What is the old ratio of Mr. A? It is 5 by 10, right? So the ratio would be 2 the, so 5 3 to the 6 minus 5 divided by 10 is equals to 1 by 10, and this is the gain ratio of whom? Mr. A. Then Mr. B. Will there be a gain ratio for Mr. B? No. Why? Who is retiring? Mr. B is retiring. So Mr. B is the person who is giving out his ratio. So he won't be gaining anything over here. Always the retiring partner will donate or give away his share in the profits. Clear? So he won't be gaining ever. Never ever. So B will be giving out his ratio. That is what? How much is that? 3 by 10. So 3 by 10 if I write. In negatives I will write this. Okay. So I will just rewrite this 1 by 10. Okay. Now Mr. C, that is how much? 2 by 5 minus minus 2 by 10. That would be how much? 2 to the 4. 4 minus 2 by 10 is equals to 2 by 10. Clear? So in this case, if you just add these both, how much will that be? 3 by 10. That means the ratio of 3 is to 10 is divided between Mr. A and Mr. C in these particular ratios, in these two particular ratios. Clear? So whatever goodwill we have the partner. So basically, if let's say the firm's goodwill is 1 lakh rupees. So the total goodwill will be how much? 1 lakh into, sorry, the total goodwill of the retiring partner will be how much? 3 by 10. So that would be 30,000 rupees. So 30,000 goodwill should be given to whom? To Mr. B. See, in admission, whoever was coming into the partnership firm used to bring goodwill. Why? Because he was joining the firm in a midway. Right? But in case of retirement, what happens? Since the partner is leaving the firm, he has contributed for the firm. See, the Krishna, the person whoever is retiring now, so this guy has contributed so much to the firm. So what these both do, the existing partners will give out some part as the goodwill to whom? To Krishna. Okay, that will be computed as so, and this will be divided in what ratio? In 1 by 10 and 2 by 10. So basically 1:2 will be the gain ratio, 1:2 will be the gain ratio, which will be dividing for the purpose of journal entry. Then going ahead. So case number 2. Now what has happened? W, A, B and C. So 4 partners are sharing profits and losses in the ratio of 1 by 3, 1 by 6, 1 by 3 and 1 by 6 respectively. B retires and W, A and C decide to share the future profits equally. Now first of all, write down the old ratio. So what is my old ratio? So it is, let's make it equal to 6. So 2 by 6 is to 1 by 6 is to, again 2 by 6 is to 1 by 6. So that would be 2 is to 1 is to 2 is to 1. So who is retiring? Mr. B is retiring. So Mr. B's share would be not this one, this one. 2 by 6 will be the share of Mr. B. So W, A, B, C, right? So therefore 2 by 6 will be the share of whom? Mr. B. So I will just mark this one. Okay. So now tell me the new ratio. So as per the question, the new ratio is in what ratio? This is the profits are shared equally between whom and whom? W, A and C. So 1:1:1 is the ratio shared between all these 3 partners. Now again, how to find out the gain ratio? Again, so Mr. W, first of all start with Mr. W. So W's old share is how much? So before is new share. So 1 by 3 minus, what is the old ratio? 2 by 6. That would be 2 minus 2 by 6 equals to 0. So that means Mr. W has not gained anything. Right? Then going ahead, Mr. A, again 1 by 3 because it was equal, right? Minus 1 by 6 this time. So now 2 minus 1 by 6 equals to 1 by 6. Then what about Mr. B? Mr. B has not earned anything. So 0 minus if I do 2 by 6, that means he has donated or given out how much? 2 by 6 of his share in the profits, right? Basically the old ratio, whatever it is. So Mr. C, again 1 by 3 minus what? Minus 1 by 6. So minus 1 by 6, that would be 2 minus 1 by 6 equals to, sorry, not 3, minus, right? So 1 by 6. So now again, if I add these both, how much will that be? 2 by 6. So that means whatever the 2 by 6 share of Mr. B was there has been divided between Mr. A and Mr. C in what ratio? In 1:1 ratio. So whatever goodwill is there, they will be dividing it between these both people and giving it out to Mr. B in equal ratio. Clear? Then going ahead. So case number 3. A, B, C are partners sharing a profit and losses in the ratio of what? 4 by 9, 1 by 3 and 2 by 9. Then Mr. B retires and surrenders what? 1/9 of his shares in the favor of A. So out of the whole share, whatever he had, it is 1 by 3. He is giving 1/9 to whom? To Mr. A. And remaining 8/9 will be given to whom? 9 will be given to whom? To Mr. B. Sorry, to Mr. C. To Mr. C. Clear? Now, and the remaining in the favor of C. Okay, fine. So, what I can do over here is, whenever the word surrender comes up, multiplication. Remember, in admission we have seen. So, for Mr. A, out of 1 by 3rd, he's giving out how much? 1 by 9th of share. So, that would be how much? So, 1 1 by 9 3 27. Then, for Mr. C, out of 1 by 3, 1 by 3, he is giving out how much? 8 by 9th of share, 8 by 9th of his share, right? So 8 by 27. Now the gain ratio is equals to 1 is to 8, 1 is to 8. Fine. Now going ahead, find out the new ratio. So new ratio is equals to how much? New ratio is equals to whatever old ratio was there plus the gain ratio. Why, sir? Why gain ratio should be added? See, whenever the partner retires, he will give out his share or the profit share, whatever is there, to the remaining partners, right? To the remaining partners. So these partners will acquire it. Whenever I am getting something, being the remaining partner, I am getting something over here. That means it will add to the old ratio I had, right? So the formula will be old ratio plus the gain ratio. So for Mr. A, the ratio will be what was the old ratio? 4 by 9, right? So 4 by 9 plus what is the gain ratio? 1 by 27. So this would be 4 3 is 12 plus 1 divided by 27 is equals to 13 by 27. And then for Mr. B that would be how much what is the old ratio? 2 by 9. So 2 by 9 plus 1 by what is the old ratio? Gain ratio 8 by 27. 8 by 27 is equals to 3 is so 6 plus 8 divided by 27 is equals to 6 plus 8 would be how much? 14 by 27. So the new ratio of the remaining partners is how much? 13 is to 14. This is the new ratio. Clear? This is how you compute the new ratio and the gain ratio depending on the questions. So now let us see how to do the accounting for the partnership in case of a retirement of a partner. Okay, so the steps remain all the same. So first we'll prepare what? Something called as revaluation account. We'll prepare revaluation account, and after that whatever profit or losses in the revaluation, profit or losses P&L of revaluation will transfer to what? Transfer to partners capital account. Partners capital account. Now comes the question, to which all partners should I give it? So there were 3 partners, Krishna, Karthik and Chinmay, right? So in our case, Krishna was retiring, right? So to whom to give the profits and losses of the revaluation? The profits and losses of the revaluation will be given to all the 3 partners. Why, sir? Because see, whatever profits and losses are there, it was because of the revaluation of assets and liabilities. There are some increases, there were some decreases in my assets and liabilities. So now these increases and decreases belong to whom? To all the 3 partners, because these 3 partners were the partners for a long time. Now out of that only Krishna is being retired, right? So because of that I need to divide this profit and loss from the revaluation to all the 3 partners in their what? In their old profit sharing ratio. Clear? Okay. So now once you create partners capital account, now what to do in the partners capital account? So we will do these all things. So revaluation account is done, to transfer is done. So now after this we will compute the goodwill and divide among the partners without opening goodwill account, just like we did in the partnerships. What? In admission of a partner, the same adjustment will be done in the what? In the retirement also. What will be the journal entry? Gaining partner's capital account debited to sacrificing partner. Since sacrificing partner, who are sacrificing? Who is sacrificing over here? Retiring partner is sacrificing over here. Yes, in some cases because of the ratios here and there, the existing partner can also sacrifice some of the amounts to the different partners. That depends on case to case. But generally it is the retiring partner who will sacrificing. See, once a partner is going out of the partnership firm, he will have some profit sharing ratio. This he will divide between whom now? See, Krishna was retiring, right? Krishna was retiring. This ratio he will divide between whom? Between Karthik and Chinmay, right? Because he is retiring now. Whatever profit share he had before he was a partner will be divided between whom? Between these 2 people. So who is the sacrificing partner over here? He is the sacrificing partner over here. And these both are what? These both are gaining partners. What are they gaining? They are gaining the profit share from Krishna. From Krishna they are gaining the profit share. Clear? Okay. So the journal entry we have got it, the same journal entry what used to pass in the admissions, the same entry will be passed in the retirement also. Okay. After this, prepare partners capital account that we know to divide any reserves. So again, whatever reserves are there in the balance sheet actually belongs to all the 3 partners. In my example, all the 3 partners it belongs to, right? So because of that, whatever reserves we have in the balance sheet should be divided between all the 3 partners in what ratio? In again old ratio, because this belongs to all the 3 partners. They are really worth it, or they are really the owners of those reserves, whatever are there in the balance sheet. And for remaining adjustments. So what are the remaining adjustments? So whatever revaluation entry was there, that you should carry forward. If any capital is to be brought in, that is to be taken care of. And at the end of the day, in partner's capital account, we will pay off whom? The retiring partner. In my case, Krishna. See, Krishna will have some balances due in the partner's capital account. Why? Because he has capital, he has the profits of the revaluation, he has the bifurcation of reserves. Then goodwill is to be given to him. Why is goodwill given to Krishna? Why is goodwill given to Krishna? Because he is sacrificing some ratio to for the purpose of whom? For the purpose of these two people. So because of that, for Krishna, see, because these two people are gaining something, so these two people will do what? They will pay off Krishna through what? Through goodwill for the profits that they are acquiring from Krishna, because he is going out of the firm today, right? So because of that, goodwill adjustment is there. So all these will be added to what? Krishna's capital account. Krishna's capital account, right? But at the end of the day, there will be some balance remaining. This balance has to be paid off to Krishna, right? So this can be done in two ways. This can be done in two ways. So we have case number 1 where the continuing partners or the existing partners may discharge the whole amount or the whole claim at the time of retirement. So the entry will be partners capital account debited. Why is partners capital account debited? I would say retiring partners capital account debited. Why? Because this is the capital account, it will always have a credit balance, and to clear off the credit balance, why are we clearing the credit balance? Because he is going out today, he is going out of the partnership firm. Whatever balance was there in his capital is no more required in the firm because he is going out, right? So now because of this, he will be given the whatever share is belonging to him, so that will be debited. So to clear off the balance in the capital account, and we know that whenever the capital accounts are debited, it will be the reduced in the capital accounts. Okay, then to bank account. Why? Because I am paying off the amount, whatever XYZ amount was there in Krishna's capital account, that has to be paid to him, right? So that will be paid through what? Through bank account. And case number 2. Case number 2 is the continuing partners may discharge partial claim at the time of retirement and retain the remaining portion as a loan. See, what they can do is, first of all, they will debit all the amount of capital that was due as per the partner's capital account. Whatever amount was due to Krishna will be debited to clear it off. Okay, the second entry, partial amount, let's say 20%, 30%, 40%, whatever the ratio might be depending on the question, will be paid through what? Through bank account. And whenever bank balance reduces, we will credit the account. Yes, then next, and whatever extra balance remains, let us say 1 lakh was the balance payable to Krishna. Out of this, 20,000 has been paid through what? Through bank account. So the remaining amount of rupees 80,000 will be taken to what? To my loan account, saying that this much amount is still to be pending to Krishna. So we don't have enough cash today to pay off this amount. So what we will do? We will transfer this to a loan account. And whenever loan is a what? Out of 5 loan is a liability. Since loan is a liability, and because I am supposed to pay Krishna today, see, before the loan amount was what? Before the loan amount was 0. Now because of this entry, loan amount will increase, right? I have to pay Krishna how much today? 80,000 rupees. So it is an increase in the loan value, and whenever liabilities increases, we will credit the account. So retiring partners loan account will be credited. Clear? Got the journal entry, the logic behind both the journal entries? Fine. So after this, the last step will be what? To transfer the capital balance to the balance sheet, adjust the value of assets and liabilities as per the revaluation done in the revaluation account, similar to what you did in the admission part. Clear? Okay, so now let's jump into the main question. So illustration number 2 from your textbook. So F, G and K were partners in LLP sharing profit and losses in the ratio of 2:2:1. Okay, so they have given us what? They have given us the old ratio. This is my old ratio. Now next, K wants to retire on 31/12/2022. That is calendar year. Given below is the balance sheet of the partnership as well as other information. Okay, so on that date, on the date of retirement, they have given us what? They have given us the balance sheet of the partnership firm. Then, what are the other details given to us? F and G, that is the existing or the remaining partners, agree to share profits and losses in the ratio of 3:2 in the future. That means this is my what? This is my new ratio. This is my new ratio. New ratio is given to me. Clear? Then, value of goodwill is taken to be rupees 50,000. This is what? This is firm's goodwill, not partner's goodwill. This is firm's goodwill. So this should be multiplied with the sacrifice ratio or the gaining ratio, depending on the ratios whatever is there. So depending on that, we will divide it between what? Between F and G, and this will be paid to whom? To K by F and G. Then sundry fixed assets are revalued upwards by rupees 30,000. Okay. Inventories by rupees 10,000, upward by 10,000. Then bill receivable dishonored rupees 5,000 on 31/12/2022, but not recorded in the books. So there was a bill dishonored for rupees 5,000. That means, see, what is the bill receivable dishonor entry? What is the bill receivable dishonor entry? The entry will be debtors account debited to what? To bill receivable account. Right. So now what has happened over here? So there was a bill receivable dishonored which was not recorded in the book. So this part was not recorded. Only debtors value was reduced in the books, it seems. So it's a rectification of error. So basically, debtors value will increase, right? Debtors value will increase, or I can say the bills receivable value will decrease, right? See, in this case, includes a bill receivable of rupees 20,000. So in this case, what has happened? Whatever bill receivable was recorded over here, the value of this will now reduce. Okay, so this will be a reduce in the asset values. Then going forward, dishonor of the bill was due to insolvency of the customer. So the customer has become insolvent. So that means the debtor's value is also not required. Then F and G agree to bring sufficient cash to discharge the claim of K and to make their capitals proportionate. Proportionate to what? Proportionate to the profit sharing ratio. Proportionate to the profit sharing ratio. So whenever they give capitals are proportionate, but they do not mention to what. It will always be assumed it will be proportionate to what? To my profit sharing ratio. Which profit sharing ratio? The new ratio. Remember this, clear? Okay. Also, they need to maintain 75,000 bank balance for the working capital purposes. Okay, fine. So, what is required? Pass the journal entries, capital accounts of the partners, and draft the balance sheet for F and G after retirement. So, first of all, what we will do is we will find out the sacrifice ratio or the gaining ratio in this case. So, the formula will be what? My gain ratio will be equals to my old ratio, my new ratio minus my old ratio. Why? Because my new ratio will be more than my old ratio, because the partners are acquiring whose ratio? The case share. So because of that, the partners new ratio will be more than the old ratio. Clear? Okay. Now let's start. So for F, what is the new ratio? 3 by 2, that means 3 by 5 minus what is the old ratio of F? F will be the first one, that is 2 by 5. 2 by 5, that will be 1 by 5. What is this? What is this? This is the gain ratio. F has gained 1 by 5. Then F, G, again 2 by 5 minus what is the old ratio of 2 by G was second, right? So 2 by 5 equals to 0. So that means F has neither gained, neither sacrificed. Clear? Okay. Now the last person is K. So K do not have any new ratio, right? So only old ratio of 1 by 5. So that will be a negative 1 by 5. That means what? F has sacrificed. F has sacrificed, obviously, K has sacrificed, pardon me. K has sacrificed because he is retiring from the partnership firm, and F has what? F has gained. So who will pay goodwill to whom? Who will pay goodwill to whom? F will pay the goodwill to K. Why? Because he is gaining from whom? From K's profit share in the future. Clear? Okay. So now, after this, let's see about the goodwill. So tell me, what to do with the goodwill? So goodwill was how much? Rupees 50,000 as per the question. Remember, goodwill was rupees 50,000. So now divide this between all the partners. So how will you do this? How will you do this? Into 1 by 5. Straight away multiply this with 1 by 5. Into 1 by 5. I will write partners goodwill. Okay. So that will be equals to 10,000. Now, what is the journal entry that will pass? What is the journal entry that will pass? Gaining partners capital account debited to sacrificing partner. Who is gaining over here? F is gaining, right? So that journal entry will be F's capital account debited. F's capital account debited to sacrificing partner. Who is sacrificing over here? K's capital. So K's capital account debited. So credited. By rupees how much? By rupees 10,000. By rupees 10,000. So 10,000 will be divided between both the partners. Now after this, come to the revaluation entries. Come back to the revaluation entries. Okay. So now what I will do is I will pass the entries here itself for you people. See, all the revaluation entries are really easy. Let's see how to do it. I have discussed this previously also. Let's start. So first of all, sundry fixed assets were revalued upward by rupees 30,000 rupees. So that means this is the amount of rupees 30,000 is the net increase, right? Is the net increase. So from 1,50,000 it has increased to what? Rupees plus 30k. It will be rupees 1.8 lakhs, right? So whenever the value of asset increases, we will debit the account or credit the account. We will debit the account. So sundry fixed assets account debited. Okay, then after this, inventory also increased upward by rupees 10,000. So inventory is also increased. So inventory is asset increases, debit. So inventory account debited. Okay, what are the values? 30,000 and rupees 10,000. So 30,000 and rupees 10,000. 30,000 and rupees 10,000. Okay, fine. Then next, bill dishonor. This is the decrease entry, so just skip it for now. Okay. So now finish off this entry first of all. So what to credit? We will credit this to what? To revaluation account. To revaluation account. By rupees how much? 40,000. This is my first entry. Then again, there's a decrease in the bills receivable, right? There's a decrease in the bills receivable value. So what to do? When a bills receivable decreases, which is asset decreases, we will credit the account to bills receivable account on the debit side to by revaluation account, or I can say revaluation account is debited with what? With bill receivable account. So by how much? Rupees 5,000. So rupees 5,000. Rupees 5,000. Okay, fine. So after this, what else is pending? So goodwill calculation is done, revaluation account is done. Next we will divide the reserves. See, because there is a reserve in the balance sheet, right? And I have told you that whatever reserves are there during admission or retirement, it should be divided between the partners, right? In case of admission, it is the old partners or the existing partners. And in case of retirement, it is the all the partners, whoever was there before retirement. Clear? Okay. So the entry will be what? Since because of the division of reserves, partners capital account will increase. So whenever capital balance increases, see, reserves are like an income to me. This is being divided between whom? Between all the three partners, in this case F, G and K. Now because this is divided between the partners, their capital balance will increase, right? Because they are getting the share of reserves, so their capital balance will increase. I'm just transferring this reserve to between these three people over here, right? So my liability of reserve or my capital, whatever is there, is being transferred to the different accounts, right? So the balance sheet will tally. But how to pass the entry now? Since reserve distribution will increase the balance of capital, I will debit or credit? I will credit the capital account, because whenever capital balance increases, we will credit the account. So the entry will be to F's capital account, to G's capital account, then to K's capital account. After this, debit what? See, reserves are kind of a capital. Reserves are a part of capital, that we know. So since capital value, see, if I divide reserves between all the partners, how much will the balance in the reserves account? 0. So that means from rupees 10,000, the reserves have become what? 0. That means the balance of reserves has decreased. And whenever capital balance decreases, we will debit or credit the account. We will debit the account. So reserves account debited. Account is debited. By rupees how much? By rupees 10,000. Now, how will you divide this? In what ratio? In the new ratio. So the entry will be 4,000, and rupees 2,000. In the ratio of what? 2:1. In the ratio of 2:1. That is the old ratio of the partners, if you remember. Right? This is the old ratio of all the partners. Okay. After is any more entries pending? Now what we'll do is, see, they have given us that F and G agree to bring sufficient cash to discharge the claim of K. Okay. Now we don't know what is the claim of K. Keep it on hold. And to make their capital proportionate, to 3:2, we should know what is the total capital. See, instead of without knowing what is the total capital, we cannot find out what is the proportionate capital. So first what we'll do, we will find out the capital value. But as per the question, they have not given us the new capital value. See, the capital value will vary. Why? Because first of all, I am dividing the profit or loss on the revaluation. See, it is not computed yet. Okay, we forgot to compute the revaluation profit or loss, so that is to be computed. Okay, keep it in mind. Next, so see, basically the partner's capital account, I will divide the revaluation profit or loss, I will divide the reserves, I will divide the goodwill. After all these adjustments, I will get the balance remaining in the partner's capital account. Now in my case, I don't know that. Why? Because as they have told us, the capital should be proportionate to what? To my new profit sharing ratio. So now what we'll do is, remember single entity system where we used to find the capital. How we used to find the capital? By preparing something called a statement of affairs. So in this case also, what we will do is, using all the revalued figures, we will find out what? We will find out the value of capital as the balancing figure. See, bank account balance was given to us, but the new balance in the bank should be what? Rupees 75,000. This information is also given to us. So what we'll do is, we will do is, we'll prepare a small balance sheet. So let's prepare this here. Okay. balance sheet after retirement. Okay, just mention after retirement. After retirement. Now, write down all the assets. So we have fixed assets. Then after this we have inventories. We have inventories. Then trade receivables. Trade receivables including what? Including the bills receivables. Then bank account. Now go on telling me all the balances. See, 1,50,000 plus what? Plus there's an increase. Remember, there was an increase in the value of sundry fixed assets. So by rupees 30,000. So the new value will be rupees 1,80,000 rupees. See, I'm not writing the working note. Please write down the working note. In the brackets, just write down 1.5 lakhs plus 30,000 rupees. Clear? Okay. Then inventory. Inventory has also increased. Remember, debited by rupees how much? By rupees 10,000. So 50,000 rupees plus 10,000 rupees. How much will that be? Rupees 60,000. Then trade receivables again. Rupees 70,000 was the value. Rupees 70 was the value. But out of this 20,000, what has happened? We have reduced the value of bill receivable by rupees how much? By rupees 5,000. So the total value of trade receivables will be 75,000 minus 5,000. That will be 65,000. Bank account balance they have given us that it should be rupees 75,000. Remember that the bank balance should be after retirement. Also they have wanted to maintain rupees 75,000 in the balance as the working capital. So clearly they have mentioned that what is the balance should be. Then on this side I think we have creditors. This side we have capital account and we have trade payable. See, will this be taken to the new balance sheet? No. Why? Because this has been already divided between all the three partners, right? Okay. So now trade payables, there is no change in the balances. So trade payables will remain as it is. So rupees 50,000. Yes, rupees 50k. Okay. Now find out the closing balance of capital. So 1,80,000 plus 60,000 plus 65,000 plus 75,000 minus 50,000. That will be rupees 3,30,000. So that will be rupees how much? 3.3 lakhs. Between whom and whom? Between F and G only. F and G only, right? Why? Because these are the remaining partners after retirement, right? So F and G. Now in what ratio should I divide this? In what ratio should I divide 3.3 lakhs between both the partners? In the new profit sharing ratio, that is my 3:2 ratio. So divide it. So that will be 3,30,000 divided by 5 into 3 equals, that is 1,98,000. Then 2 equals rupees 1,32,000. Clear? So these are the new what? New capital balances as per the capital accounts. Now what will I do with this? I will tell you that in the partners capital account. Okay, but before that, remember we had not prepared the profit or loss over here. So pass an entry for that. So revaluation account is credited by rupees 40,000 and debited by rupees 5,000. That means my credit is more than my debit. My credit of revaluation is more than my debit. That means we will have a profit or loss. We will have a profit or loss on revaluation. We will have profit because my profits are more than my losses. Remember? Okay. So the entry will be what? Revaluation account debited. Revaluation account debited. Revaluation accounts debited. To what? To partners capital account. To which partners capital account? To all the partners capital account. So F's capital to G's capital to K's capital. Okay. Yes. Okay. What is the profit? Rupees 40,000 minus rupees 5,000. So that will be rupees 35,000. So rupees 35,000 is the profit. See, my credit was more than my debit. So now I will pass the entry on debit. Why? Now because if you add debit over here, it will be rupees 40,000 and on the credit we have 40,000. So that means my debit will be equal to credit. See, whatever balance in the revaluation account, that should be cleared and transferred to what? To the partner's capital account. This is what we have learned in the admission of partners, right? So because of that, I am clearing out whatever balance was remaining by passing a debit entry. But if in case debit was more than credit, if in case my debit was more than my credit, the entry would have been passed on the credit side. The revaluation account would be passed on the credit side. Clear? Okay. Now divide this in what ratio? In old ratio. What is my old ratio, sir? My old ratio is 2:2:1. So 2:2:1. So divide this. So 35,000 divided by 5 into 2 equals to 14,000. Should be 14,000 and 7,000. So 2:1 ratio done. Okay, now prepare partner's capital account. So now in partner's capital account, first we will start with what? First we will start with what? With the capital balance. So whatever entry I pass on debit side will increase the balance. Whatever entry I pass on the credit side will decrease the balance. Yes? No, this is wrong. Whatever entry I pass on the credit side will increase the balance, and whatever entry I pass on debit side will decrease the balance, because it's a capital account, and capital account nature is capital increases capital increases credit, capital decreases debit. So now opening balance of capital, how much? I'll just erase this. Okay, so these are the opening balance of capital: 1,20,000, 80 and 60. So 1,20,000, 80,000, and at the end 60,000. This is called as what? Buy or to buy balance brought down. After this division of reserves. So buy reserves. Look at this entry. Look at this particular entry, right? So now what? Reserves account 4,000, 4,000 and 2,000. 4,000, 4,000 and 2,000. 4,000, 4,000 and rupees 2,000. Then after this, then there was a revaluation profit. Remember, revaluation account entries over here itself. 14,000, 14,000 and 7,000. 14,000, 14,000 and rupees 7,000. Then next entry, goodwill division. Where's the journal entry? Right, between F and K only. G is not at all bothered about this particular entry. So who is paying whom? Rupees 10,000. Who is paying whom? Who is paying whom? Tell me. So goodwill entry, buy, we don't know for now. Let's keep it on hold. Don't pass the entry by looking at buy or to. Clear? Okay, this is the most worst form of passing an entry. So who is receiving the goodwill? Who is receiving the goodwill? Mr. K, because he is retiring today, so he will be receiving for the sacrifice he has made. How much is the amount he is receiving? Rupees 10,000. So what entry you pass? You cannot pass case account again, because you have passed the amount in the case column. So you cannot pass the entry as K, but you will pass the other head. Who is paying? Who is paying? Mr. F. So F's capital account. And on the other hand, since F is paying it off, his capital balance will reduce. So whenever capital balance of F reduces, we will debit or credit. We will credit the entry by rupees how much? We will debit the entry by rupees 10,000. So to whose account now? Can I pass F's account? No, I will pass K's capital account. Clear? Okay. If you want to verify, you can verify the entry by 2 and 5. 2 case account by F's account. Same entry is passed over here. 2 case account by F's account. Yes? Okay. Anything else to be passed? Okay. First of all, let's balance case capital account. So as per the question, just have a look. Is anything maintain? So now we will balance of case capital account. So look at the question. See, F and G agree to bring sufficient cash to discharge the claim of K. That means K's claim, whatever is there. What is K's claim? Whatever capital balance remains in the partner's capital account, that has to be paid to whom? K. So as per the question, they are paying it off on spot. And not keeping it as a loan. So what we'll do, we'll pass a bank entry to clear off the loan. Okay. So let's see. So in my partner's capital account, what will we do? So balance of case account now. So starting with rupees 60,000 plus 2,000 plus 7,000 plus 10,000 equals to rupees 79,000 is remaining. Rupees 79,000 is remaining on the credit side. So this will be paid through what? Through bank account. Now case account is completely cleared from my books of accounts. Okay. Now let's go to the F and G. But in case of F and G, what is mentioned over here? That their capital should be made proportionate, and to make that proportionate, what should they do? They should bring in some cash. They should bring in some capital. And we have already found out the value of capitals. Remember over here, 1,98,000 and 1,32,000 rupees. Yes? Okay. Now pass this as the closing balance. This is the closing balance of capital. So go back to balance carried on. Rupees how much? 1,98,000. This is the closing balance we have found out separately, right? Using the new profit sharing ratio. 1,98,000 and 1,32,000. 1,32,000. 32,000. Okay. Now Try to balance partner's capital account for F and G and see if there's any closing balance or any balancing figure. What does that balancing figure mean? That balancing figure means they have to bring in some cash or pay off some cash depending on each case. Let's see. So let's start with F's account. 1,20,000 plus 4,000 plus 14,000 minus 10,000 minus 1,98,000. That will be negative 70,000. That means on the debit, sorry, on the credit side, by bank bank account, this is what my balancing figure, rupees 70,000, rupees 70,000. That means Mr. F has brought in some more capital. See, whenever I pass the entry on the credit side, what does that mean? The capital balance is increasing, and whenever capital balance increases, in this case it means that he has brought in some amount in the bank account. Clear? Okay. Now let's start with G. So 80,000 plus 4,000 plus 14,000 minus 1,32,000. That will be again negative 34,000. So negative 34,000. So that will be 34,000. So that means Mr. F will bring in how much? 70,000. Mr. G will bring in how much? Rupees 34,000 as a new capital. Clear? Okay. Now let's prepare balance sheet. Okay, actually balance sheet is already prepared for you people. Okay. See, in your study material, what they have done is they have taken this particular format as, first of all, they have taken it as to find the value of capital. They have shown a statement. Clear? And then they have again prepared a balance sheet. So that's what you need to do. But for the purpose of understanding, I have prepared the balance sheet first of all. Clear? Okay. So now let's prepare bank account for the sake of finding the bank balance. Let's see. So bank account. So what is the opening balance? So any entry on debit will increase the balance. Any entry on the credit side will decrease the balance. So first of all, to balance brought down. How much is the balance in the bank account? Bank account balance was rupees 50,000. So rupees 50,000 is the balance. Then again, buy balance is given to us already. Yes, buy balance is given as per the question. Rupees 75,000. Remember in this part. See over here, the balance is already given to us. Right? Okay. Now, what has happened? So first of all, we have paid Mr. K. Right? We have paid Mr. K. So the entry will be for the payment. Whenever I pay, the bank balance will reduce. So by whose account? By K's capital account. So by rupees how much? Rupees 79,000. So rupees 79,000. Then after this, again on the credit side, there is a bank account entry. That means these both, who F and G, have brought in capital, their own capitals, right? So the entry will be on the debit side because the bank balance will increase. So by, sorry, not K, F's capital account and to G's capital account, rupees 70 and 34,000. Is goodwill brought in? It's not a case of admission. Remember, in case of admission only, sometimes partner brings in the goodwill. So the balance of the bank will increase. But in this case, we are paying it off, right? By adjusting it in the capital account itself. So because of that, no goodwill comes in the bank account. Clear? Okay. Now try to balance it and see if it balances or not. Rupees 50,000 plus 70,000 plus 34,000 minus 79,000 minus 75,000. So our bank account is being tallied. Clear? So we are done with the problem. Next. So now let's start with illustration number 5. So Dowell LLP with partners Mr. A, B and C sharing profit and losses in the ratio of 10:60:4. So this is what my old ratio. Now the balance sheet of the firm as on 31st March 2022 is as under. So capital are given, reserves is given. So what to do with this? This is unappropriated profit, it seems. So this is the profit which is to be divided between whom? Between A, B and C also. Clear? Between all the three partners, this has to be divided. Then long-term debt, bank overdraft. Okay, fine. All the assets are given to us. See, bank account is not given to us. Okay, keep this in mind. Bank account is not given to us. So that means that there is no balance in the bank account. In simple terms, if the bank account is not given over here, that means the balance is 0. Clear? Okay. It was mutually agreed that Mr. B will retire from the partnership and in his place Mr. D will be admitted as a partner with effect from 1st April 2022. Now this is the case of retirement come admission. So in this case, both a partner is retiring and a new partner is being admitted. So merger of both the chapters. Clear? Okay. For this purpose, the following adjustments are to be made. First one, goodwill is valued at rupees 1 lakh, but the same will not appear in the book assets is of the reconstituted firm. Clear? We know how to pass the entry. What is the entry? Gaining partner to sacrificing partner. Then building and plant and machinery are to be depreciated by 5% and 20% respectively. Clear? Investments are to be taken over by the retiring partners at rupees 15,000. Okay, fine. Provision of 20% is to be made on trade receivables to cover the doubtful debts. Fine. So this all these entries will go to what? To my revaluation account. Revaluation account. Yes. Then in the reconstituted firm, the total capital will be rupees 2 lakhs. So in the previous question, they had not given us how much the total capital will be. But in this case, they have given us what? The total capital should be rupees 2 lakhs, which will be contributed by the Mr. Mr. A, Mr. C and Mr. D. Mr. B has already retired. So Mr. A, C and D will remain in the firm. D was the newly admitted partner in the firm. In their new profit sharing ratio, which is 2:2:1. This is what my new ratio. The surplus funds, if any, will be used to pay the bank overdraft. See, we have a bank overdraft over here. Yes, for rupees 44,000. So, if there is any balance remaining in the bank account after using it for all the purpose, this will be first utilized towards paying of the bank overdraft. And if anything remains in extra, it will be shown as a asset in the balance sheet for XYZ amount. Clear? Okay. Then, the amount due to the retiring partner shall be transferred to his loan account. In the old question, in the previous illustration, we have seen that whatever the balance was remaining for the retiring partner, it was paid off on spot. But in this case, we are transferring it to what? To a loan account. Saying that his balance will not be paid on spot, but we will transfer it to a loan account and pay in the future date on some interest basis. Then, what is required? We are required to prepare what? Revaluation account, partners capital account, bank account and the balance sheet of the reconstituted firm as on 1st April 2022. Okay. So first of all, find the ratios. First let's start with the ratios. Okay. So ratios, what I will do is, see, in this case it might be a bit complicated to you people. So what we will do is, old ratio. Just write old ratio. Old ratio. We have A, B, C and D. Right, so I'll just shift it over here. Okay. So what is the old ratio of all the three first A, B, C? It is what? 10:6:4. So 10 plus 6 plus 4 will be 20. So the ratio will be 10/20, 6/20 and 4/20. Okay. Now comes the new ratio. New ratio is what? 2:2:1. But will Mr. C have new ratio? Sorry, who retired? Mr. B, right? Mr. B will retire. So will Mr. B have a new ratio? No. So in case of Mr. B, I will write retired. So the new ratio is what? 2:2:1. So 2 plus 2 plus 1 is 5. So 2/5. Then again 2/5 and at the end 1/5. D. Clear? Always the new partner admitted will be the last ratio. Clear? Okay. So now we need to find what? We need to find gain ratio, right? So, okay. Computation of gain ratio. So my gain ratio is equal to what? The formula? New ratio minus old ratio. So for A, let's start. For A, what is the new ratio? 2/5. 2/5 minus new ratio is 10/20. 10/20. Okay, so what is the new old ratio? Sorry, the gain ratio. So I can just compute it 4 to the 8 minus 10/20 is equals to negative 2/20. Then for B, it is 6/20 minus nothing. So new ratio is not given, so it is nil. Wait a minute, okay. So new ratio is not given, so it is 0 minus what? 6/20. 6/20 is equals to negative 6/20. Then for C, what is the new ratio of C? 2/5. Again 2/5 minus what is the old ratio? 4/20. 4/20. 5 4 20. So 8 minus 4/20 is equals to 4/20. Then next. Mr. D 1/5. So Mr. D only the new ratio is given, right? So 1 by 5 minus 0 will again be 1 by 5. If I have to equate 1 by 5 to 20, how much will that be? 5 4 is 20, so 4 by 20. If you see 4 plus 4 is how much? 8. 6 plus 2 is how much? 8, right? So these both have what? These both have what? Combinedly sacrificed, whereas these both have gained. So who will give the goodwill to whom? Who will give the goodwill to whom? So basically Mr. C and Mr. D will pay goodwill to whom? To Mr. A and B, because both of them have sacrificed, whereas these both people have gained. So the gaining partner will give the goodwill to the sacrificing partners. Now find out the value of goodwill for these partners. So what is the value of goodwill? Okay, the goodwill is valued at rupees 1 lakh, right? So what I can do is straight away 1 lakh, or else first of all pass the entry. First of all pass the journal entry. The entry will be gaining partners to sacrificing partners, right? So gaining partners are C and D. So gaining partners are C and D. So the entry will be C is capital account debited. D is capital account debited. 2. Sacrificing partner. Who is sacrificing over here? Mr. A and Mr. B are sacrificing. So A's capital account to B's capital account. See, I told you before that only retiring partner need not sacrifice. While changing the ratios here and there, it might be that the remaining or the existing partner can also sacrifice some ratio to the other partners, just like in this case. Clear? Okay. So the entry. So straight away what you can do is multiply 1 lakh with these values. Straight away multiply 1 lakh with these values. You will get your answer. So 1 lakh into, first of all, 2 by 20. So 1 lakh into 2 by 20 will be rupees 10,000. So for Mr. A, it is 10,000. Mr. A, 10,000. So for Mr. B, it is 6 by 20, right? So 1 lakh divided by 20 into 6 if I do, rupees 30,000, Mr. B. Then Mr. C is 4 by 20. So simply 4 equals to rupees 20,000, and for D it is again 4. So 20,000. So if for verification, what you can do is add this, right? 40,000 plus 40,000. Okay. So my both debit and credit are matching. So we have got the journal entry for the goodwill adjustment. Clear? Okay. Now what to do? Now let's prepare revaluation account. So we will prepare it over here. Revaluation account, debits, credit. Okay. So now building, plant and machinery are to be depreciated by 5% and 20%. So first of all, building by 20%. So building into 20%, how much will that be? 4, so 40,000. So depreciated, building value is reduced. So to building, how much will that be? 40,000. After that, plant and machinery by 5%. So 1,30,000 into 5%. 6,500. So to plant and machinery 6,500. Then after this, investments are to be taken over by retiring partner at rupees 15,000. So now retiring partner is taking over what? Investments. But at what amount? At what amount? 15,000. Actual amount of investments is what? Rupees 12,000. So he is paying more for an investment of rupees 12,000. He is paying rupees 15,000 for an investment of rupees 12,000. So he is paying more. That means I am gaining. The partnership firm is gaining how much on investments? By investments. 15k minus 12k. That would be rupees 3,000. After this, what else? Okay. Provision at 20% to be made on trade receivables to cover the doubtful debts. So 20% of 1,39,000, 1,39,000 into 20%. That will be 27,800. So doubtful debts, it's a loss kind of thing. So 2 doubtful debts or provision for doubtful debts. How much? Rupees 27,800. See, everywhere please mention a small working note in the brackets. 1,39,000 into 20%. I am not mentioning it specifically. Clear? But for examination purpose, please write it somewhere. Okay? Because examiner should know how are you getting the answers. Clear? Okay. Now find out whether there is a profit or loss. So 3,000 minus 40,000, minus 6,500, minus 27,800. That will be a loss of rupees 71,300. 71,300. Okay. I think I made a small mistake. Plant and machinery value I have computed wrongly. Okay. So actually the depreciation was how much? 20% on plant and machinery. So into 20%, and on building it was 5%. So on building it was 5%. Right. So let's recompute these two values. Just a minute. Into 5%, that is 10,000. My bad. 10,000. 1,30,000 into 20%. That will be 26,000. Okay. Yes. Now recompute. 10,000 plus 26,000 plus 27,800 minus 3,000. That will be rupees 60,800. Rupees 60,800. What is this? This is my revaluation loss. This is my revaluation loss. So to partners capital, this is my loss. This loss has to be divided between whom? Between all the old partners. All the old partners. Who is that? A, B and C. In what ratio? In old ratio. What is the old ratio? 10 is to 6 is to 4. Right. So what I can do is 60,800 divided by 20 straight away, because 10 plus 6 plus 4 will be 20. Into 10 equals to rupees 3,400. Then 6 equals to 80 into 40. That last is 4 is equals to 12,160. Okay. Where will these amounts be transferred to? Where will these amounts be transferred to? These amounts will be transferred to the partner's capital account. Clear? Okay. Now let's prepare partner's capital account. So now we have prepared the partner's capital account. Let's start. So starting entry will be what? The capital account, right? So whatever entry I pass on the credit side will increase the balance. Whatever entry I pass on the debit side will decrease the balance. So the opening balance will be on this side. So by balance brought down, how much is the opening balances of the partner's capital account? 80, 20 and 30. So 80,000, 30,000 and 20,000. These, because these does not have any opening balance. Whatever was there, he has brought in the firm. Okay. After this, so by reserves, remember there were some reserves which are not divided. See, most of the students will miss to pass the reserves entry. So whatever reserves are there, even though it is not given in the question to divide it, we should divide it. Clear? It is a implied rule. So reserves is rupees how much? 20,000. Divided between what ratio? 10 is to 6 is to 4. So the amount will be 10,000, 6,000 and 4,000. That is total of 20,000 rupees. Then there is a revaluation loss. Right, this will be transferred to the debit side, because whatever revaluation loss is there, it will reduce the value of capital. So whenever capital value reduces, we will debit the entry. So on this side, to revaluation account. How much is the value? 3,400. 80 into 40. 12,160. Okay. Just a thought. Let us say in the question they ask you to prepare memorandum account, memorandum revaluation account. Then what will you do? See, first of all, you will prepare a revaluation account kind of format where you will divide whatever the profit or loss in what ratio? In the old ratio. Then after preparing the revaluation account, you need to prepare memorandum. So basically you will reverse all the entries. Right? You will reverse all the entries. Now you will get a profit. In this case, in my example, now you will get a profit. So this profit has to be divided in what ratio? This profit has to be divided in the new ratio between whom? A, C and D. Okay. Mr. B won't receive anything. Remember. Clear? Okay. After this, anything else? Goodwill entry. Goodwill. Now straight away pass the entry. So 10,000 and 3,000 is being received by whom? A and B. Right. So 10,000 and 3,000. Sorry, 10,000 and 30,000 rupees. So 10,000 is received by A, whereas 30,000 is received by B. Okay. So the entry will be what? By can I pass A and B's capital account? No, I should pass the reverse of that. So that is C's and D's capital account. Since I don't know the proportion, I will just pass the entry as a clubbed entry. C and D's a capital account. Then on this side, who is paying? They are paying who? C and D are paying how much? 20 and 20, right? So in C's and D's capital account, on the other side, 20,000, because it will decrease the value of capital because they are paying it off to the sacrificing partners, right? So now the entry will be what? To A and B's capital account. A and B's capital accounts, right? Because I cannot pass C and D again. Clear? Okay. Now what to do? After this, anything else pending over here? I think we have some investments, right? See, investments are to be taken by the retiring partner at rupees 15,000. See, since retiring partner is paying for the investment, his capital value is reduced, right? So he's not bringing in any new cash to pay it off, but he's adjusting it with the capital account. So what he's saying is, see, since you have to pay, make me some payments, this plus this, sorry, minus this. So that payment you make me partially through what? Through investments of rupees 15,000. So the entry will be to investment account. To investment. How much? Rupees 15,000. See, the journal entry will be this much. Since investment value is being reduced, since partner is taking out the investment, the investment account will reduce. So to investment account. To investment account rupees how much? 15,000. Clear? And on the debit side, partners capital account. Partners capital. Which partner? B's capital account. I will just mention B's capital account. B's capital account debited. Why? Because partners capital value will reduce. So whenever partners capital value reduces, we will debit the account, and whenever investment reduces, why is investment being reduced? Because partner is taking it over. Partner is taking it over as his personal asset. So because of that, investment value in the balance sheet will go on reducing, and whenever asset reduces, we will credit the entry. Clear? Okay. Now try to balance it off. So now try to balance B's account. So what is given over here? B's amount due, whatever is due of the retiring partner shall be transferred to his loan account. So whatever amount is remaining to the B will be transferred to his loan account. So balance of B's account. So 30,000 plus 6,000 plus 30,000 minus 18,240 minus rupees 15,000 will be 32,760. I've got a small mistake over here. This is 20,000 and this is 30,000. Okay, no fine. Now try to balance it again. 20,000 plus 66,000 plus 30,000 minus 18,240 minus 15,000. That will be rupees 22,760. So 22,760 will be what? Will be transferred to loan account. So the entry will be 2 B's loan account. 2 B's loan account. Clear? What will be the journal entry? Partners capital account debited or B's capital account debited to B's loan account. Why is B's loan account credited? Because loan account is a liability, and whenever liability increases, we will credit the account. So I have credited B's loan account. Clear? Okay. Now comes to the remaining partners. For remaining partners, there was something given to us. Remember, proportionate or something. So now what we need to do? We need to find out the proportionate capitals of all the remaining partners. That is A, B, and D. So what have they given us? They have told us that the total capital will be rupees 2 lakhs, which will be contributed by Mr. A, C, and D. In what ratio? In the new ratio. It is 2:2:1. So divide 2 lakh in this ratio. How much will that be? Rupees 2 lakh in the ratio of what? 2:2:1. That is 5, right? So 2 lakh divided by 5 equals to into 2 equals to 80,000. For A it is 80,000. Then for B it is not there. So for C it is again 80,000. Same to 2. Then for D it is 1. So that will be 40,000. So 80, 160, 160 plus 40 is 2 lakhs. Okay. So I have got what? My 2 balance carried on. How much is it? 80,000. Then again Mr. B nothing is there, so nil. Then 80,000 and 40,000 for Mr. D. Now try to balance off all the remaining accounts. So first, let's start with A. So 80,000 plus 10,000 plus 10,000 minus 3,400 minus 80,000. So 10,400 on the negative side. That means Mr. A will bring in capital. So by bank account, this is what my balancing figure. Rupees 10,400. Then after this, B's account 20,000. Sorry, B's account is already done, so don't touch it. Now let's try to balance Mr. C's account. 30,000 plus 4,000 minus 12,160 minus 20,000 minus 80,000 equals to 78,160 on the negative side. That means on the debit side. Sorry, on the credit side. So Mr. C will also bring in capital. Now about Mr. D. Mr. D is on the credit side. There is nothing. That means only debit side remains, right? So these two amounts. So 20,000 plus 40,000 equals to rupees 60,000. So 60,000 will be brought in by Mr. D. 60,000 will be brought in by Mr. D. Clear. Okay. Now next. See, they have told us that if any surplus fund remains, then it will be used for what? towards repaying the bank overdraft. But is there any opening bank account balance? See, they have asked us to prepare what bank account also, right? So is there any opening bank account balance? Nothing is given. So we will prepare bank account now. Let's prepare bank account. My bank account, debit, credit. Okay, any opening balance? No opening balance, so skip it. Now, there are some entries for amount being brought in, right? By whom? By Mr. A, C and D. The entry will be balance increases, so debit whenever the balance increases and credit whenever the balance decreases. So, to A's capital, to B's capital, to D's capital, sorry, not B, C's capital and to D's capital. Rupees how much? 10,400, 78,160 and rupees 60,000. Clear? And then any payments done? No payments are done, right? So what to do? What to do? First of all, pay off the bank overdraft. How much is the value in the bank overdraft? Rupees 44,000, right? So 44,000 will be paid off by bank OD. Bank OD 44,000. So now check the remaining balance. Remaining balance will be the balance remaining in the bank account. 60,000 minus 44,000. That will be rupees 1,04,560. Clear? This will be called as by balance carried on. Carried on to what? Carried on to my balance sheet. Now let's prepare balance sheet. Let's see. So what I will do is I will prepare the balance sheet here itself. Okay. I won't make a new entries. I will prepare the balance sheet here itself. Now, first of all, land value remains the same. Don't touch it. So building value is reduced, right? By rupees how much? By rupees 10,000. So the new value will be rupees 1,90,000. Then plant value is reduced by rupees how much? 26,000. So 1,30,000 minus 26,000 will be 1,04,000. Then furniture value as it is. Investments have been completely deleted from the balance sheet because it was taken over by whom? Mr. B, the redirecting partner. Inventories, any entry? Investments done. Inventory, nothing. Trade receivables has decreased by how much? Rupees 27,800 because we have prepared doubtful debts, right? So trade receivables minus doubtful debt. Please write it. So that will be net of what? How much? 1,39,000 minus 27,800. 27,800. That would be rupees 1,11,200. And also we have bank account over here now, right? We have prepared bank account. How much is the value in the bank account? It was rupees 1,04,560. So 1,04,560 is the balance over here. Okay. On this side, let's see. Reserves, whatever was there has been cleared off, so remove it. Bank overdraft has been cleared off, remove it. No changes in the liabilities, so don't touch it. And what about the capitals? Capitals, new balance. Mr. A, Mr. C and Mr. D. What are the new balances? 80, 80 and 40, I guess, right? See, these are the new balances carried on in the partner's capital account. 80, 80 and 40 in the partner's capital account. So 80k, 80k and 40k. The total will be how much? Rupees 2 lakhs again. So I will just mention it over here only. Rupees 2 lakhs. Now try to balance the balance sheet. Let's see if it balances or not. So first of all, capital side, the liability side. So 2 lakh plus 3 lakh plus 1,70,000. That will be rupees 3,73,000. After this, on the asset side, 10,000 plus 1,90,000. 10,000 plus 1,90,000 plus 104,000 plus 43,000 furniture. Investments is not there. Inventory is 1,30,000 plus 11,111,200 plus 104,560 equals to. There is a small difference. Let's see how. Okay, what did we miss? So the total of this will be 6,92,760. What did we miss? What did we miss? So we have missed this part. See, B's loan account was there. Remember, one thing we have missed to take the loan account. So take the loan account of B. So I will just write it out somewhere else. Loan account. B's loan account. How much was the value? 22,760. 22,760. Okay, now let's recompute it. So 2 lakh capital plus 3 lakh long term debt plus 1 lakh 70 trade payables plus 22,760 loan from B. So 6 lakh 92,760 is the value of capital, value of my asset balance sheet total. So my balance sheet is being tallied. Clear? Okay. So this is how we need to prepare the balance sheet and the partner's capital account. Okay. So one question in the textbook. Okay, this was illustration number 5 of retirement cum admission. Now there's one more question, illustration number 4. It is a bit trickier. Okay, I will just teach you in the PDF itself. Okay, so look at the question now. So KLM and a partners sharing the ratio what? 5:3:2. Due to illness, L wanted to retire from the firm on this date, so admitted his son in his place. So Mr. L is being retired, and in his place his son N is being taken over as a partner in the partnership firm. Then they are given in the balance sheet. Fine. On retirement, L's assets were revalued. So all the assets of the partnership firm were revalued. So they are given in the furniture revaluation, inventories. Now 50% of L's amount due was paid off to L in cash. So whatever amount was due to L has been paid off in cash. How much? Only 50% of the amount has been paid off. And the balance was retained in the firm as a capital of N. So Mr. N or the son of Mr. L has not brought in any capital, but he has what? He has retained the capital of his father in 50%. 50% of the capital of L has been paid off. See, in our old question, whatever the balance was remaining has been taken as a loan. But in this case, what they have done, 50% is being taken as what? As the repayment, and remaining 50% is taken as what? As the capital of N. So then what has happened? I will just erase all these things. Then what has happened? On admission of new partner, the goodwill was valued at rupees 50,000. We know what to do with this. The partners are being paid off in extra balances to make the capital proportionate. Now look at this. By keeping N's capital as a base. Okay. N's capital as a base. So have they given us the new ratio? That is the question. So they have not given us the new capital ratio, right? So we'll assume that it is in the equal ratio, or we can assume that, let's see what they have assumed in the question. I think they have assumed that whatever was the new ratio. So what they have done is, see, old ratio was 5:3:2, right? But for the partners' new ratio, what they have done, they have retained it, and they have given L's share to Mr. N. See, 3/10. See, L's share was 3/10. It has been given to whom? To N now. And all the remaining old partners the partners' capital ratio is remaining the same. So they have found out the sacrifice ratio over here, gain and sacrifice. So L is sacrificing, whereas Mr. N is gaining. Remaining partners are not gaining, not sacrificing. Mr. M and N, K. Now, look at the journal entries once. Okay, the same entries what we have prepared. This is the revaluation entry, P&L adjustment account, also called as revaluation account. Okay, then now this is the division of profit or loss. So in this case it is a loss, I guess, right? See, furniture is credited, inventory in trade is credited. That means it is a loss. So the loss has been divided between all the three partners. Then after this, there is a reserve in the balance sheet. Again, it has been divided between all the partners. Same entry what we have passed before. Then now look at this. What to do? Now find out the value remaining in L's capital account. How to do that? So check wherever L's capital account is mentioned. Check wherever the L's capital account is mentioned. I will just mark it now. I will just erase all these things. Okay. So see where L's account is mentioned. So one is over here, rupees 9,000, and one more over here, reserves division. Okay. So first of all, always try to imagine partner's capital account. Now imagine partner's capital account in your heads. So first we start with what? We start with the capital balances, right? So what is the capital balance of L? Go to the balance sheet. L's capital balance is rupees 60,000. So 60,000 you press on debit. Sorry, on credit side. So add. What is credited again? In L's account we have credited what? Rupees 15,000 from reserve. So add 15,000. Less revaluation loss. There was a loss of rupees 9,000 on revaluation. Less rupees 9,000. So how much will remain? Rupees 66,000 is remaining. Anything else to be entered? Goodwill adjustment. Remember, goodwill adjustment. So who is to pay goodwill to whom? So open the capital profit sharing division. Okay. So in this case, who has to pay whom? In this case, I will just erase this all things. So who has to pay to whom? L is being paid through N, right? Because L is sacrificing whereas N is gaining over here. L is sacrificing whereas N is gaining over here. So who is to pay whom? Mr. N will pay it to Mr. L. So L's balance will increase. L's balance will increase. Where is the entry passed? Over here. He is sacrificing whereas he is gaining. So sacrificing partner's capital account debited to gaining partner's capital account. How much? Rupees 15,000. So add 15,000 to 66,000 rupees. So it will be rupees 81,000. So here if you see 81,000 is debited. See there was a credit balance of 81,000. So now I am clearing off L's balance completely from the books of accounts. I am clearing off L's capital balance completely in the books of accounts. Now whenever I need to clear off any capital account, I will debit the account. So L's capital account is debited by rupees how much? By rupees 81,000. By rupees 81,000. Then as per the question, how should this be paid off? So 50% of the amount will be paid off to L through cash or bank, and remaining balance will be retained as a capital of Mr. N. So look at the journal entry. Whatever 81,000 was there has been paid off through bank. How? For rupees 4,500. So into or divided by 50% or divided by 20 divided by 2. So 40,500 has been paid through cash or bank, and the remaining has been taken as N's capital account. Whenever capital value increases, N was admitted to the partnership firm. Whenever N is admitted to the partnership firm, he will bring in capital. But in this case, he is not bringing in any capital. His father is giving him the capital. Who is his father? Mr. L. Mr. L is giving him his capital share. How much? 50% of the remaining balance. 50% of the remaining balance, that is 81,000. Yes, whenever capital of Mr. N increases, we will credit the account. So Mr. N's account is credited over here. Clear? By rupees 40,500. Now comes to the remaining partners capital. So they have told us that what? That okay. Partners are being paid off their extra balances to make their capital proportionate by keeping N's capital as a base. So they have not given us the new capital value. They have given us not given us the any balance sheet to find out the difference value, just like in old examples. But they have told us that N's capital will be the base to find out what? To find out the remaining K and M's what? The new capital values, right? So, but before finding out the N's capital, will this be the balancing figure? Sorry, will this be the final value? No, because N has given some goodwill to whom? To his father, right? This entry, remember? So, N's capital will be, N's capital is equals to 40,500 minus goodwill given. How much? 15,000 as per the question. As per the question, 15,000 is the goodwill given to 15,000 is the goodwill given, right? N's capital account has been debited. So whenever any capital account is debited, that means it will reduce. It will reduce the value of capital. So minus this. So now the new value will be how much? 40,500 minus 15,000 equals to 25,500. So 25,500 is the capital for how much profit sharing ratio? For an equivalent profit sharing ratio of how much? His father's profit sharing was how much? His father's profit sharing was 3 by 10. 3 by 10. Remember? Or let's just look at the entry over here. His father L's profit sharing was 3 by 10, which was given to him as a new profit share, right? So 3 by 10 for a ratio of 3 by 10. So now that means what? Find out the reverse compute and find out the capital. So for 25,000, if the profit sharing is this much, wait, just a minute. 25,500 into 10 by 3. I have just reversed the proportionate, the ratios. So how much will that be? Into 10 by 3 equals to 85,000 will be the total capital. 85,000 will be the total capital. So now find the value of remaining partners. So M and K. Sorry, K and M. For K and M we will find out the capital value. So 85,000 into what? Into the new ratio. What is the new ratio of K? 5 by 10 remains the same, and M 2 by 10. So into 5 by 10 into 2 by 10 equals to, so 85,000 divided by 10 if I do into 5 equals to 42,500. Then M is equals to 17,000. So let's look at the balance sheet to confirm it. See, 42,500, 17,000,
22, 25, 500. Clear? So this is how you need to compute the value of capitals in this question. Okay, and everything remains the same, and everything remains perfectly the same. Just remember, see, always sometimes we miss while doing this computation. We might miss doing this computation. Okay, we sometimes forget to minus the goodwill. Okay, so always go through the journal entries. Clear?
Now, let us see what is joint life policy. So we have three cases. So first of all, let us understand what is a joint life policy. See, there's a partnership firm. There's a partnership firm. Okay, and there are three partners. For example, A, B, and C. Okay, now what the partnership firm does is, since all the three partners are really important for the partnership firm to run its day-to-day business, so because of that, it takes something called as, in the name of all three partners, it takes something called as joint life policy. It is exactly similar to your life insurance, where if a person dies, he will get the majority amount. Okay, if a person dies, he gets the whatever is assured from the insurance policy. But let us say if he surrenders the policy prematurely, let us say the life policy was taken. The life policy was taken for 5 years. He pays a premium of 3,000 rupees each year. Each year he pays a premium of rupees 3,000 rupees. Okay, and some assured is, let's say, rupees 1 lakh. So tomorrow if he dies or his life is gone, he will receive a sum of rupees 1 lakh. But if he surrenders it, let's say there are different policies. Let's say 2025, 26, 27. Now, if he surrenders the policy in 2025, he will receive nothing. If he surrenders in 2026, he will receive only 10,000 rupees. If he surrenders in 2027, for example, he receives, let's say, only 13,000 rupees. So and so on and so on. It varies on year. If he surrenders, what does surrender mean? Surrender means asking the insurer to give back the money and give him the policy, saying that from here onwards I won't be paying any premium and I won't claim the life insurance if something happens to my life. I want to surrender. I want to forego the rights on my policy. So because of that, the policy assurer will give him only a certain amount and not the whole amount, which is sum assured. Sum assured will be received only when the person dies. Similarly, in case of a joint life policy in the partnership firm, what happens is the firm pays for the partner's life jointly. So the firm says if any one of the partner dies, tomorrow the firm will receive the proceeds from joint life policy of so and so amount. Okay, this will be assured by whom? By the insurance company, whatever the insurance company can be. HDFC Life, SBI Life, there are so many insurance companies. So, but if it is surrendered in between the year before 5 years, if the policy is surrendered, in that case, the firm will receive only a small amount of the policy amount. Clear? Let us understand that better with the questions. But now, for now, understand it is just similar to your life insurance policy. Now, how do you pass the journal entries? So there are three cases. There are three different cases. The case number one is if the joint life policy premium paid is considered as an expense. Whatever premium you pay, just like in our example, we had paid what? Premium of rupees 3,000 each year, right? So if this premium is paid, what will you treat the premium as? In this case, in case number one, we will take it as an expense, So what is journal entry you pass? So joint life policy premium account debited. Why? Because whenever expense increases, we will debit the account. So this will be a expense head, right? And to bank account. Why? I am paying it. So this is my asset head. Clear? Then whatever premium you have paid, it has to be transferred to what? To my P&L account. So I have created an account over here. Now by transferring it to P&L account, I will reduce the value of premium account, premium ledger account. So joint life policy premium account will be created in my ledger account. What will I do in my ledger account? First I will pass the internal debit side. Why? It is an expense, so increases, and then while writing it off, I will just pass the internal credit side to what? By P&L account, to transfer all the amount of expenses to what? To my P&L account. Clear? This is how you pass the entry. This part was explained in what? In the P&L account of the proprietors. Remember? Okay. Then after this, on maturity of the policy, we receive some certain amount. Like, right, a lump sum amount is being received from the insurance company. In that case, partners capital account will be credited. Why? Because whatever profits and losses are there will be affected to what? To partners capital account. So because of that, each partner's capital account in what? In profit sharing ratio will be transferred to what? To the partner's capital account. After that, insurance account insurance company account or the bank account will be debited. Why? Bank account will be debited whenever I receive the amount. But if it is receivable, it is due to be received. In that case, insurance company account will be debited. Why? Showing it as an what? Asset or as an debtor. As a debtor. Right? Clear. Now, case number 2. In case if the policy premium account is treated as an asset. So what we will do is we will first understand how to pass the entries in case number 1. And then we will go to case number 2. When joint life policy is taken as what? Taken as asset. Clear? Okay, let's see, look at the question. Okay, look at the question. Illustration number 7. Red, white, black shared profit and losses in the ratio of 5:3:2. Okay, they took out joint life policy in 2018 for 50,000 rupees, where a premium of rupees 3,000 being paid annually on 10th of June. So each year on 10th of June they are paying a premium of how much? Rupees 3,000. How much is the sum assured? How much is the sum assured for the policy? It is rupees 50,000. So tomorrow, if any one of the partner dies, the firm will receive how much? Rupees 50,000. Then the surrender value of the policy on 31st December of various years is as follows. So first of all, we have in 2018, see, the policy was purchased in 2018, and if in 2018 if I surrender it, how much will I receive? I will receive nothing. I will receive nothing. Then in 2019 if I surrender, I will receive 900 rupees. In 2020 if I surrender, I will receive 2000 rupees, and in 2021 if I surrender, I will receive 3600 rupees. Okay. Now Black has retired on 15th April 2022. That means policy will be automatically surrendered. Why? Because since it is a joint life policy, it is a joint life policy which has been taken on the life of red, white, and black. So if any one of the partner retires from the firm, if any one of the partner retires or dies, okay. But in this case, in my this example, so death part we'll see when we're talking about death of a partner. But in this case, since Black has retired, and since it is a joint life policy taken on jointly on the life of all the three partners, because of that, the policy will be auto surrendered. And I will receive only the surrender amount, right? See, on 15th of April, the policy has been surrendered. For 2022, they have not given us any surrender value. So we will assume that 2021, whatever surrender value is there, only that value we are receiving. Clear? Okay. So now, required, prepare ledger accounts assuming no joint life policy account is maintained. So basically, they are asking us to prepare the joint life policy premium account, which is an expense account. So let's prepare that. So we'll prepare joint life policy premium account. Joint life policy premium account. So what is this account categorized as? It is a expense account. So that means any entry I pass on the debit side will increase the balance, any entry I pass on the credit side will decrease the balance. Clear? Yes. So now make a small date column also this time. Now, okay. So whenever I pay a joint life for a premium, will my joint life policy premium ledger account, premium ledger account will be debited or credited? See, since it is an expense account, and whenever I pay a premium for the joint life policy, my expense will increase, and whenever expense increases, we will debit the account. So, on what date is the premium paid? Dates they have mentioned. Okay, 10th annually, right? So, first date will be 10th of June 18. To what? To bank account. Rupees how much? Rupees 3,000. Then after this, for the year end, where will this amount be transferred to? Since we know that whatever expense and income accounts are there, it has to be closed during the year end. Because of that, I will transfer whatever amount remains, whatever the balance is there, will be to the P&L account. So on 31st of December 2018, I will transfer it to what? To P&L account. This is a transfer entry for rupees 3,000. This is my first year. Next, for the next year again, on 10/6/19, again I am paying a premium. Yes, of rupees how much? 3,000. And again on the same date of 19, what will I do? I will again transfer it to the P&L account. Same thing. I will repeat the same thing until the premiums are paid. So till what date the premiums are paid? Till what date? See, we will assume that since he has retired on 15th of April, for 2022 the premiums are not paid. Why? Because it is already surrendered. And once the policy is surrendered, I need not pay any premium. Why? Because it is already surrendered. There is no policy in my books as an asset or something, right? So because of that, I have surrendered the policy, no premium to be paid. For which year? For 2022, right? Because it will be paid on what? 10th June of 2022. But since he is already retired, policy is auto surrendered. Clear? So now, that means the insurance premium is paid till what date? Till 2021. So I will just skip the remaining entries and straight away go to the last entry 621 to bank account rupees 3000, and on the same 31st December 21 by P&L account. I will transfer the entry to the P&L account rupees 3000. Clear? And now if I ask you to prepare P&L account, simple. This is my P&L account. At the year end, I will pass a entry. So since it is expense, I will debit what? To joint life policy premium rupees 3000. For each year, I will go on passing the same entry for all the 4 years, whatever is there. Clear? On the credit side, there is no entries. This is what you need to do when you are taking it as a expense. You are taking it as a expense. Clear? Now, case number 2. Prepare ledger accounts assuming joint life policy account is maintained. What is this? This is my asset account. This is my asset account. It's maintained under surrender value basis. Now what to do? Now let's see. Joint life policy account. This is what nature of the account is. It's a asset account. It is a asset account. So any entry I debit will increase the balance. Any entry I credit will decrease the balance. Okay, fine. Now, whenever I pay a joint life policy, it will increase the value of my asset. In this case, I am not treating it as an expense right now. I am not taking it as an expense right now. I am taking it as an asset, right? So whenever I pay, I get an asset, right? So whenever I pay the premium, I will get an asset. So because of that, the value of asset will increase. So on what date? On 10th of June 18 to bank account. Because whenever asset value increases, we will debit the account. So rupees 3000 was the premium paid. Clear? Yes. Now, as per the question, this has to be maintained on surrender value basis. Okay. Now let's see what to do. Now there's a twist over here. See, is rupees 3000 the whole value can be taken as asset? That is the question. Can the value of rupees 3000 can be fully taken as a asset value? I would say no. Why? Because in 2018, check the surrender value. In 2018, what is the surrender value? It is nil. That means whatever rupees 3000 I have paid, if I surrender in 2018, I won't receive anything. I won't receive any amount. A single penny will not be given to me. So because of that, whatever amount I have paid will be transferred to the P&L account, right? So on 31st December 18, by P&L account, rupees 3000. No balance will be there in the asset account for the first year. Why? Because my surrender value is 0. Clear? Next, going on to the next year. So 10/6/19, again I have paid through bank. So to bank account, rupees what? 3000 again. But in the second year, what is the surrender value? In the second year, what is the surrender value? 2019, it is rupees 900. That means 900 value is a asset to me. So what about the remaining amount? The remaining amount, whatever I have paid, is a expense. So it will be transferred to the P&L account again. So the entry would be on 31st/12/19 by P&L account. How much is the value? 900 is the surrender value. So remaining amount of rupees 3000 minus 900 will be what? Taken as a expense in the P&L account. And on the same date, by balance carried down. How much? Rupees 900. This 900 rupees, whatever is there. This 900 rupees, whatever is there, will be taken as what? Will be taken as a asset in the balance sheet. In the balance sheet, I will take it as a asset. Clear? Okay. Then going on. Next year done. Going to the next year. So again, on first of all, opening balance, right? So 1/1/2020, to balance brought down. Whatever the closing balance was there will be carried forward as the opening balance because it's an asset account, and we know that asset account balances will always be carried forward to each the next years. 900 rupees. Then again on 10th of June 2020. To bank, again I am making a payment of rupees how much? Of rupees 3000 as the insurance premium. Then now, what is the total value in the balance sheet? Rupees 3000 plus 900 is how much? 3900. But what is the surrender value? What is the surrender value over here? The surrender value will be for this third year 2020 rupees 2000. So therefore, we have a asset value of how much? Rupees 3900. But what is the surrender value? Rupees 2000. So therefore the difference will be taken to what? The difference will be taken to the P&L account. How much is the difference? 3900 minus 2000 rupees. So 1900 will be taken to the P&L account. So again on 31/12/19, 20, just a minute, 20 by P&L account. How much? Rupees 1900. So how much remains as the balance carried forward? Carried on the same date? Rupees 2000. Clear? Okay. Now coming to my last year. Just a minute. Now coming to the last year, again on 1/1/2021, I will have a opening balance brought down. How much? Rupees 2000. And I will again pay on 10/6/21. I will again pay a premium by bank account. How much? Rupees 3000. So now what is the value of joint life policy over here? It is rupees 5000. Why? 2000 plus 3000 rupees. So that a total of rupees 5000. But what is the surrender value? What is the surrender value for the fourth year? It is rupees 3600. Therefore, the difference amount will go to 5000 minus 3600 will go to my P&L account. Clear? So 1400 will be the P&L item. So on 31/12/21 by P&L account rupees 1400. Then on the same date by balance carried down, how much? Rupees 3600, I guess, right? 3600. Okay. After this, again on the next date, 22, balance brought down rupees how much? 3600. Now what has happened in the if calendar year 2022? In 2022, what has happened? Mr. Black has retired, right, on this date. So on that date, what will happen? The policy will be auto surrendered, and I will receive what? I will receive the surrender value of rupees 3600. I mean, okay. So whatever asset of JLP is there, it need not be maintained. Why? Because it is already surrendered. And whenever I surrender it, the asset should be written off from the books of accounts. So while I write off the books of accounts, I should debit the entry or credit the entry. I will credit the entry because I need to reduce the value of asset in my books because the asset is no more worth in my balance sheet, right? So what to do now? So will I pay a premium? No, because it is paid on 10th. But when is he retired? On the April month, right? So because of that, on 15th of April 22, by bank account, because I am receiving the money. Whenever I receive the money, bank account will debit it. Yes, clear. So how much will I receive? Rupees 3600. So because of this, my asset account has been completely closed off. My asset account has been completely closed off. Clear? Yes. So in P&L account, what to do now? So in P&L account, if you prepare, transfer all these amounts. Transfer all these amounts to the P&L account. Simple, just like we did over here. Similarly, go on transferring all the amounts to the P&L account. Only single entry in the P&L account, that is to JLP account. Okay, whatever the amounts of premiums we have discussed over here. Okay. So one more thing I forgot to mention to you people is, okay, in this case, what if the policy is surrendered? What will happen with the amount, right? See, we receive the amount. Where will this amount go? See, since we have transferred all the insurance premiums to the P&L account, right? So therefore, there is no asset being maintained in the books of accounts. So now what to do then? So in that case, whatever amount we receive, we open a new account. We don't open a new account. We transfer it to partner's capital account. See how to do that. So first of all, whenever I receive amount, the bank account will debit it. Yes, for rupees how much? 3600. That is my surrender value. Now this amount will transfer to the partner's capital account. Clear? This amount, whatever is there, will be transferred to partner's capital account. This will increase the value of partner's capital account. That is to what was the name? Red, white, and black. Okay, red, white, and black. 532 is the ratio. Red, white, and black. So red's capital account to black's capital account to white's capital account. I think the order is changed. Let's see once. Red, white, and black. So 5, 2, 3. 5, 2, 3. I just changed the names over here. These names are interchanged, so I have changed the ratios also over here. Okay, so now divided 5 plus 2 plus 3 plus 5 plus 2 plus 3 is 10. So 3600 divided by 10 is equals to 360 into 5 equals to, so 1800, then 2 equals 720, then 3 equals. So this is the entry that you pass whenever you receive the amount and you are not maintaining any any joint life policy account as an asset in the balance sheet. Clear? Yes. So hopefully this is completely clear. Then going ahead, the last question of this chapter.
So the first question from your practical questions or test your knowledge questions. On 31st of March 2022, the balance sheet of measures Ram, Rahul and Rohit sharing profit and losses in the ratio of what? In the proportion to their capital. So the whatever the ratio they have is in the proportion of the capital. This is the capital. So tell me the profit sharing ratio. So the old ratio is equals to what? 3 is to 2 is to 1. Clear? I just mark this for you people. So the old ratio as per the capital proportion, as per the proportion of their capital is how much? 3 is to 2 is to 1. Now, so the balance sheet is given to you. Then, now let's look at the entries. On 31st March 2022, Ram desired to retire from the firm and the remaining partners decided to carry on. Okay. So who has retired? Mr. Ram has retired over here. Clear? It was agreed to revalue the assets and liabilities as on a date on the following basis. So land is to be appreciated, land and building to be appreciated by 30%, machinery to be depreciated by 20%, closing stock to be valued at 80,000 rupees, provision for bad debt at 5% to be maintained, old credit balances of the sundry creditors rupees 10,000 rupees 10 written off. So out of rupees 2 lakh 10,000 has been written off. Okay, then joint life policy of the partners surrendered and cash obtained is rupees how much? 60,000. So 60,000 has been received from the joint life policy. There can be two different adjustments for this. I will tell you what to do. Okay, fine. Now, then goodwill of the entire firm to be valued at rupees 1 lakh 80. Okay, and Ram's share of goodwill to be adjusted in the accounts of Rahul and Rohit, who share the future profits equally. So future profits are equal ratio. So the new ratio is equals to 1 is to 1 between whom? Between Rahul and Rohit. Between Rahul and Rohit, the ratios are equal. Clear? No goodwill account is to be raised. That we know already. Clear? Now comes the important part. The total capital of the firm is to be same as before retirement. Individual capital be there in the profit sharing ratio. So that means whatever the total capital of the firm after retirement should be equal to the old capital before retirement. So how much was the capital before retirement? It was rupees 6 lakh. See, do not take these values. Do not take those values. Remember, clear? Whenever they are saying that total capital of the firm, that means they are referring to this particular part. So total capital after retirement for Rahul and Rohit should be how much? Rupees 6 lakh. And this should be divided in what ratio? In profit sharing ratio. That means in the equal ratio of 1 is to 1. Clear? So 6 lakh divided by 2 basically. So 3 lakh into 3 lakh. Then amount due to Ram is to be settled as 50% on retirement and balance of 50% within 1 year. So we are transferring the remaining 50% to what? To Ram's loan account. Prepare revaluation account, capital accounts of partner Rahul and Rohit. Okay, loan account of Ram, then cash account, balance sheet as on 1st 1/4/2022 of measures Rahul and Rohit. Okay, fine. So first of all, what we'll do, we will find out the gain ratio. So computation of gain ratio. So we have Rahul and Rohit, right? What is the name? Ram, Rahul and Rohit. The formula will be what? New ratio minus old ratio. What are the new ratios? 1 is to 1. So for Ram there is no ratio, so keep it nil. So for Rohit it is 1 by 2. For Rahul it is 1 by 2. For Rohit it is 1 by 2. Minus. Let me keep it as 0. Minus. What is the old ratio? It is 3 is to 2 is to 1. So 6 total. So 3 by 6, 2 by 6 and 1 by 6. Now find out the ratio. So this will be negative 3 by 6. Over here 6, right? 3. So 3 minus 2 by 6 equals to 1 by 6. Then here again 3. So 3 minus 1 by 6 equals to 2 by 6. So that means these both partners are gaining over here and this partner is sacrificing over here. Clear how to do this? Okay, just to confirm what you can do, 1 plus 2 is equal to 3. So 3 by 6 is the total sacrifice ratio. Then pass the journal entry. But before passing the journal entry, find out the amounts. What are the amounts? So goodwill is rupees 1 lakh 80 of the total firm. This is the firm's goodwill, not Ram's goodwill. So how do you find Ram's goodwill? Ram's goodwill will be, or the Ram's share of goodwill. Ram's share of goodwill will be equals to 1 lakh 80,000, that is firm's goodwill, into his sacrifice ratio, that is 3 by 6. How much will that be? 1 by 2 I can do 1,80,000 divided by 2 equals to 90,000. 90,000 rupees. Okay. Now divide this between Rahul and Rohit. Between Rahul and Rohit. How much will that be? 1 is to 2, 1 is to 2 ratio. 1 is to 2 ratio. So 1 by 2. So I can divide this by 3. So 30,000 for Rahul and 60,000 for Rohit. Clear? Yes. Now pass the journal entry. Gaining partner account debited to sacrificing partner. Who is gaining over here? Who is gaining over here? Who is gaining over here? Rahul and Rohit. Both are gaining, right? So the entry will be Rahul's capital account debited. Rohit's capital account debited. 2. Who is sacrificing over here? Mr. Ram is sacrificing over here. So 2 Ram's capital account. Okay. Now divide the amounts. Rahul, how much? 30,000. Then Rohit, 60,000. Then total value of capital to be given is 90,000. What is the next step? To prepare revaluation account. So now prepare revaluation account. Let's see. Revaluation account. Start one by one. So first of all, land and buildings are appreciated by 30%. So land and building are appreciated by 30%. So 30% of 2 lakhs will be how much? 60,000. Yes, 60,000. So it will increase, right? So 2 land and building. Please write the working note. Remember to write the working note in the brackets on how did you get the amounts. Then after this, machinery is depreciated by 20%. So machinery into 20%. How much will that be? 2 lakh into 20%. 40,000 rupees. Yes. So by machinery. Oh, wait a minute. I just made some mistakes over here. Sorry. So, sorry. By land and building. Land and building, how much? 60,000 rupees. Then to machinery. Machinery, 40,000 rupees. After this, closing stock to be valued at rupees 80,000. So from 1 lakh, the value has been reduced to what? To 80,000 rupees. So it is a decrease in the value, right? So to inventory or to closing stock, how much rupees? 20,000 decrease. See, because they are given at, right? They are given valued at. So this is the final value. This value of whatever is given is the final value, right? So since this is the final value, I am doing what? 1 lakh minus 80,000. Clear? Okay. So the provision for bad debts is how much rupees? At 5%. So to provisions at the rate of 5%. How much will that be? Sundry debtors into 5%. 5 to certain. So 1,000 rupees. Let me just confirm it once. Into 5%. Okay. 10,000 rupees. Sorry. Yes. No. The old credit balance of sundry creditors of rupees 10,000 to be written off. So whenever the value of liability reduces, it is written off, right? So since the value of creditors is being reduced, it is an income to me. So by creditors. By rupees how much? 10,000. Okay. Anything else pending? Okay, we are done. So now balance is off. So 60,000 plus 10,000 minus what? 40,000 minus 20,000 minus 10,000. 60,000 plus 10,000 minus 40,000 minus 20,000 minus 10,000. So there is no profit, no loss here. No profit, no loss. So the accounts are already tallied. Here, this is the first way of doing it. Second way of doing it is, see, since we have received, see, point number 6, joint life policy, if the partner surrendered and cash obtained rupees 60,000. So here what we can do is, see, either you take it to revaluation account or you can take directly to the partner's capital account. Clear? If you are taking it to the partner's capital account, divide it among the partners in whatever the old ratio is. Clear? But if you are taking it to the revaluation account, take it as an income. Take it as an income over here. By JLP. How much? Rupees 60,000 has been received. So now there will be a closing balance of rupees
60,000 on the debit side, which is the income to me. See, at the end of the day, the net effect will be the same because you are transferring it to the partner's capital account from here onwards. The net effect will be the same whether you take it as a revaluation item or a partner's capital item. I will tell you what to do in the partner's capital account. So, what are the partners' name? Ram, Rahul, and Rohit. Ram, Rahul, and Rohit, right? Yes. So 3 is to 2 is to 1. 3 is to 2 is to 1. So 6, right? So I can simply take 30,000, 20,000, and 10,000. Okay. This is my what? Revaluation account. If I take joint life policy in the revaluation account, but if I don't take the joint life policy in the revaluation account, this won't be there. There will be no profit or loss in the revaluation. Clear? Okay. Now let's go to the partner's capital account. So we are preparing partners capital account. Any entry on debit will decrease the balance, any entry on the credit side will increase the balance. So start with the opening balances. So by balances carried down, sorry, brought down. How much is the balance? Opening balance of capitals 3 lakh, 2 lakh, and 1 lakh. 3 lakh, 2 lakh, and 1 lakh rupees. Any reserves? First of all, check for reserves or profit and loss. So as per the balance sheet, no reserves are given to us, so skip it. Next, after this, profits will be transferred to the credit side, right? Because it will increase the balance of the capital by revaluation account. By revaluation account, how much? 30,000, 20,000, and at the line 10,000. Done. What else? What else? I think goodwill adjustment is pending. Goodwill adjustment. So Rahul is paying 30 and Rohit is paying 60. So since they are paying it off, to whom? To Rohit. How much? Rupees 90,000. So Rohit's balance is increased. So by Rahul and Rohit's capital account, and then on this side, how much is Rahul paying? I think 30,000, and over here 60,000. So the entry will be to Ram's capital account. Clear? Okay. So goodwill adjustment is also done. So now next what else is pending? Let me just check it. So Rahul 30, Rohit 60. Okay. Next what to do? I think we are done with this, and the last thing remaining is the capital adjustment. So for capital, what they have given over here, that the total capital of the firm is to be the same before retirement, and the individual capital to be their profit sharing ratio. So what will we do is, new capital is equals to how much? 6 lakh rupees. Why? Because this was the old capital. If you remember, 3 lakh plus 2 lakh plus 1 lakh was the capital, right? See, 6 lakh was the capital. This has to be the new capital of the firm. So because of that, I will keep it same. Now after this, how much will be the Rohit share? How much will Rahul share? Rahul, Rohit. The new profit sharing ratio is 1:1. Remember. So because of that, it will be divided equally between both the partners. 3 lakh and 3 lakh. If anything is excess, he will withdraw. If anything is deficit, he will bring in. Right? So 2 balance carried down. Ram nothing. So Rahul 3 lakh. Rohit also 3 lakh. But before this, let us settle Ram's accounts. Because in Ram's account, what have they told us? That amount due to Ram is to be settled 50% on retirement. So as soon as he retires, 50% is to be given off to him. And the balance 50% within 1 year. Right? So what I will do is, first of all, balance of Rahul's account, Ram's capital account. So 3 lakh plus 30,000. So 3 lakh 30 will be the balance. So out of that, divide by 2 if I do. So 1 lakh 65 is to be paid on spot. So I will pay off 1 lakh 65,000 on spot. How much will that be? To bank account. Because I am paying it through bank account. Clear? Then the remaining amount, whatever is there, will be what? Ram's loan account. Will be transferred to Ram's loan account. How much will that be? Again 1,65,000 rupees. So by this, we have settled off what? We have settled off Ram's capital account. If you see, 3 lakh 30, 3 lakh 30. Clear? Okay. Now let's start with Rahul's account. Balance of 2 lakh plus 20,000 minus 30,000 minus 3 lakh.
equals to negative 1,10,000. So that means he is bringing in capital. So by bank account, on the Rahul's column 1,10,000. Then Rohit, 1 lakh plus 10,000 plus 90,000 minus 60,000 minus 3 lakh equals to again negative 1,60,000 rupees. So that means these both are bringing in capital. So this is my balancing figure. Oh, I made a small mistake I think over here. This has to be taken to Ram's account. This is actually Ram's account, right? Goodwill. These two are proper. Only this is the issue. So this part will change. This value will change. Goodwill was wrongly given to Rohit's account. Sorry. So 3 lakh plus 30,000 plus 90,000 equals to 4 lakh 20. So 4 lakh 20 divided by 2. Half will be given through bank account and remaining half will be given through loan account. Okay. So Rohit's you recompute. So Rohit's account 1 lakh plus 10,000 plus 60,000. Sorry. 1 lakh plus 10,000 minus 60,000 minus 3 lakh equals to 2 lakh 50. Negative 2 lakh 50,000. Yes. Now, what about the joint life policy? See, since we have shown that the joint life policy is taken to what? To my revaluation account, right? But I can take this also under partner's capital account on the debit side as what? By bank account. Bank account 1, 2, 3. Divided between all the three partners. See, remember this entry or whatever we have passed. Remember this entry. Previously we had passed this, right? So similar entry has to be passed because in the question, if you see in the question, they have nowhere given you the joint life policy that is being maintained as an asset, right? So because of that, I will assume that whatever premium you have paid previously has been taken as an expense. So whatever amount you receive tomorrow will also be taken to what? To the partner's capital account. Because see, at the end of the day, whatever profits or losses you earn in a partnership firm will indirectly affect the partner's capital account. So because of that, whatever amount you receive again has to be charged back to the partner's capital account only. Clear? Okay. But at the end of the day, the answer will be same. Okay. Either you take it as a revaluation item or you take it as a capital account item. The answer remains the same. Clear? Okay. So let's prepare the balance sheet. Before that, let's prepare bank account. Let us prepare bank account for now. Bank account. Opening balance of bank account. So cash and bank account is given. So rupees 1 lakh. To balance brought down rupees 1 lakh. After this, what to do? What is received? I think partners have bought in some money. Remember, partners have bought in some money. Rupees 1 lakh 10 and rupees 2 lakh 50. So to Rahul's capital, to Rohit's capital, 1 lakh 10,000 and 2 lakh 50,000. After this, anything else? Okay, we have received some amount through joint life policy. Remember, so to what? To partner's capital account. How much? 60,000 has been received as a joint life policy. Remember, and then we have paid the retiring partner. Remember, we have paid the retiring partner also. So by what? By Ram's capital account. How much has been paid? Rupees 2 lakh 10,000 has been paid. So going back, 2 lakh 10,000 has been paid. So by balance carried on. Compute this. 1 lakh plus 1 lakh 10,000 plus 2 lakh 50,000 plus 60,000 minus 2 lakh 10,000 equals to 3 lakh 10,000. So 3 lakh 10,000 is taken to what? To my balance sheet. This will be taken to my what? To my balance sheet. Now let's prepare the closing balance sheet over here only. I will just erase all of this. Let's erase all of this. Now what are the new capitals? Ram is not no more in the firm. Rahul's capital is rupees 3 lakh. Remember, 6 lakh was the total capital divided between two partners. Rohit's capital is rupees 3 lakh. Sundry creditors value, I think it was reduced by rupees 10,000. Right? So the new value will be rupees 1,90,000. Okay, on this side, land and building, it was appreciated, right? By rupees how much? By rupees 60,000. By rupees 60,000. So add 60,000 rupees. 2,60,000. Then machinery account, it has been reduced by rupees 40,000. So the new value will be 1,60,000. Closing stock, again it is reduced by rupees 20,000. So 80,000 is the new value. Then Sunday debtors, we had provisions of rupees 10,000. So new value will be 1,90,000. Cash balance, what is the new cash balance as per the account we have prepared? It is rupees 3,10,000. 3,10,000. Okay. Anything else pending? Ram's loan account is pending. Remember, see, we have transferred some amount to Ram's loan account, right? Which will be a liability for us. So 2,10,000 as a loan. So Ram's loan, rupees 2,10,000. Now compute. So on the liability side, 3 lakh plus 3 lakh, that is 6 lakh rupees, minus 6 lakh plus 1,90,000 plus 2,10,000, that is 10 lakh rupees. So total will be rupees 10 lakhs. Then on this side, on the asset side, 2,60,000 plus 1,60,000 plus 80,000 plus 1,90,000 plus 3,10,000, that will be again rupees 10 lakhs. So that means my balance sheet is completely tallied. Okay, so this is how we prepare the retirement account. So try out all the questions in the textbooks. Okay, most of them are easy, most of them have a bit of a tricky adjustments. So just try it out by yourself. If there's any doubt, please let me know. Okay, in the Telegram channel you can just drop specifically. Please mention the doubt specifically. Don't just mention illustration number 5 doubt, because we won't be able to understand what specific doubts you have. So please mention what the doubt you have specifically. Okay, so we can give the better clarity in that. Clear? Okay, thank you.